Happy Sunday, traders. I hope you're all enjoying your weekend. You've got some well-deserved rest and you're ready to tackle the week ahead. So it's that time where I'll go over my trade ideas and what I think of the markets, and hopefully you can gain some value and formulate your own trade ideas. So you can see the watch list here for this week. If you look carefully, you'll notice the pattern. It's heavily focused on the US dollar. What that does is it leads me into some coverage here on the US dollar specifically. So what we've had, I mean, this has been spoken about quite a lot by lots of different people. We had a huge downturn on the US dollar. So what we can see is we had the carry trade starting to unwind. That's when we saw the dollar yen, we saw pound yen, we saw a lot of in fact, all of the yen pairs dip to the downside quite aggressively. We saw stock markets take a bit of a hit, and we saw the safe havens do quite well during this period. Then we also had, excuse me, we had NFP come out very, very poor. We had 89k. This was revised down to 89k, I should mention. We had unemployment come down to, go up to 4.25. Then we had the 50 basis point cut getting priced in. We had the cooling labor market, which obviously led investors to start selling the US dollar and buying other currencies or other assets. Then we had this 50 basis point cut that people were expecting. Let me just move my camera slightly here. And once we had this 50 basis point cut, we didn't actually see much of a reaction. We were just very range bound. And this is because we are very data reliant with the Fed at the moment. We need to see what is the data doing, because the Fed is data dependent. So we've seen an uptick in the dollar. We saw inflation stay at 2.5 from previous. The general target for inflation is around 2%. So this isn't too bad. It is over, but it's not too bad. We had NFP come out at 254k, which is a 100k overshoot or outperformance of what it was forecasted at, and it's an even bigger outperformance than what it was previously. So this is great news, showing a increase or a stability coming into the labor markets. We've also got unemployment dropping here to 4.1, which it was previously 4.25. So again, quite a nice signal that the labor market is starting to strengthen again. So you can see this last point here where we've got the market no longer expecting another 50 basis point cut. And again, that's relating to the data I just said with the strengthening labor market. Now investors are starting to feel like it's going to be more of a 25 basis point cut. There's also still the chance that we might have a hold, although that's a bit more unlikely. So I am, again, leaning on a 25 basis point cut. So having said that, let's get on to the charts here. So we've got the Australian dollar to start with. Now, obviously, NFP came out very, very strong. So we are looking at a relatively strong US dollar as we go into this week. We might see some retracements as the markets sort of correct themselves from Friday's news. Great idea for this Australian dollar US dollar trade. Although it's not just driven off that. Again, we are expecting overall dollar strength. So why would you want to buy the Australian dollar? Well, it's very simple. We've got the Australian dollar is likely to strengthen in Q4 2024 due to increased risk sentiment driven by China's fiscal stimulus and recovery measures. Sorry, China's economic performance is crucial to the Australian dollar, and as stimulus kicks in, demand for Australian exports, especially commodities like iron ore, could increase. Additionally, the RBA, so the Reserve Bank of Australia, is expected to cut rates in December, but the market has already priced this in, suggesting there may be more upside potential as the AUD gains strength on global growth optimism. So if we use that as a core pillar for this trade idea, and we've also got, yes, some possible short-term bullishness for the US dollar, we do also still have downside risks. Although it seems like we've had some positive short-term data, don't forget we do still have the elections coming, and the Fed does still remain data dependent, and we do still have another month to see how things develop within the US. So this is a great trade that we can look at. We do have a really nice technical setup here with the fib 0.5 and the 0.618 level through here, and we've got structure as always, so looking to potentially enter as soon as we can here, as we can see prices just rejecting this 200 moving average. So yeah, so far looked great. The problem that we may face here is, we're looking to enter relatively where price currently is. And obviously the markets tend to open with different pricing, obviously. So we will have to see how that one goes. We may get a higher entry or a lower entry. Euro USD. So this one is more leaning into both currencies. We're not trying to play one specifically. We're looking for the US dollar to strengthen in the short term, and we're also looking at the euro weakness. So we've got a slight monetary policy situation going on here where the Fed, yes, they're cutting rates, although again, due to the positive data we've seen on Friday, we might not see such an aggressive move by the Fed, whereas the ECB is not going to be taking the same approach, it seems. So the reasoning here, the Eurozone is struggling with weak growth and inflation concerns, which are likely to force the ECB into further rate cuts. The USD, on the other hand, is expected to remain strong due to US economic outperformance and the Fed's rate cutting cycle, which is projected to end sooner than that of the ECB. This widening policy divergence between the Fed and the ECB makes Euro USD a solid short opportunity. So we were looking at this last week. If you watched last week's watch list video, it's essentially exactly the same trade. Obviously the point is though that we missed this move to the downside, but to catch that obviously we would have been needed to try and trade news, which is not something I do. So we are looking for a relatively simple pull to the upside and then a continuation to the downside. So there is really two entries we can look for here. We've got the 50% retracement level here, where you can see the entries already plotted, or we have sort of a second option, which is a much smaller pullback into this previous lows and use this as a break and retest level here. So again, we'll have to see how the market develops on Monday and then maybe execute some trades on Tuesday. If you want access to profitable signals with professionally written trade ideas to back these trades up and to learn real trading standards with technical analysis and geopolitical and macroeconomic education with our videos and PDF resources, live webinars, and our proprietary research documents sent directly to you, then you can join our private Discord at elitetraders.io. Anyway, back to the video. So a very similar situation here with the pound dollar. I'm not going to cover the Fed again because I just did with euro dollar. However, with the Bank of England, we've gone from a very hawkish stance where they were saying that, there's not really any rate cuts. And then very quickly and very suddenly, they changed their mind. And now it sounds very dovish from the Bank of England, giving us this move to the downside layered on with the data from the US. So this gives us quite a nice reason to go in for a short position, obviously playing the central bank widening divergence that we're seeing. Again, very similar to euro dollar, so I won't cover this one too much. Now we do have the US dollar against the yen to the short side. So the reason is the yen has weakened significantly due to geopolitical tensions and Japan's dependence on energy imports. However, a more cautious stance from the Bank of Japan and signs that global inflation may be subduing could lead to a gradual yen recovery. As inflation eases and geopolitical risks stabilize, the yen could appreciate. Additionally, hedge-related demand for the yen at its weaker levels is likely to prevent significant further declines. And again, we've got relatively mixed US standpoints at the moment. Yes, we've got some, again, short-term positive data, but what is the Fed going to do in November? It's still a little bit of a grey area. So this could be a great sort of hedge if you are looking more towards the bearish side on the US dollar. We do have this daily moving average, and again, we've got this fib level that does line up with previous structure. So it does look quite solid technically, but yeah, fundamentally, it's not something I will personally take, but I thought it would be worth mentioning for this video. So one that I'm really interested in here is oil. I think oil is a huge, has huge potential. So within Elite Traders, where our long-term target is sort of anywhere between $80 to $100 a barrel. And this is obviously heavily driven by the tensions in the Middle East, causing some supply concerns. Obviously, if there's a lower supply, there's high demand driving prices up. So the reasoning here, we've got geopolitical tensions in the Middle East, particularly between Israel and Iran, could lead to supply disruptions, which could push oil prices higher. Though the actual impact on oil production is still uncertain, the risk premium is likely to support higher oil prices in the near term. Additionally, potential US labor strikes affecting key ports could exacerbate supply chain disruptions, adding to further upward pressures on oil. So there you go, you can see it's all basically a lack of supply within oil at the moment. And just want to highlight the specific bit here where it said the impact on oil production is still uncertain. that could actually be quite a good factor for a bullish oil. If people aren't totally sure, they'll be a bit more fearful, hence may be willing to pay a little bit higher for oil than they originally would. So you can see the long-term target here is around $90. We may even extend this to $100 a barrel, depending on how the geopolitical situations develop in the future. Moving on, we have gold. I think, gold's been on my watch list for weeks, if not months, and I think it's been on everyone's radar. The problem is we're still waiting for a good entry. We're currently ranging, and this, comes from two things. Again, we've got the relatively good data out of the US recently pushing gold down. However, we do still have the risk off side of gold, which is pushing it up, causing this sort of range that we're seeing. So we're not seeing any sort of clear direction yet. Which, to be honest, leads me to sort of just say gold is a no trade zone at the moment. There's nothing you can really do here. I would still like to see a larger time frame pullback, but that doesn't seem to be on the cards right now. So one of the final things I want to mention is the S&P. So I've mentioned quite a lot previously that I don't go short on the indices unless there's a very clear reason to. So I'm going to introduce you to something that I don't really do very often. It's very rare that I actually do trade like this. But it's called a mean reversion. Now, again, I've mentioned mean reversions previously, but it's not something I ever really explain because it's very rare that I actually do it. And it is quite high risk. And again, that's one of the reasons I don't do it. But the S&P faces significant downside risk due to elevated interest rates and economic uncertainty. Earnings growth is slowing, particularly within the tech sector, which could lead to a broadening market correction. Furthermore, the potential for adding additional Fed rate hikes or slower rate cutting cycle could weigh on equities in the near term. So it's not a super clear trade idea there, but it is something to pay attention to. Now, there is quite a common theme within sort of the retail space at the moment is the S&P is very overvalued, and that's not limited to just retail actually. I know that JP Morgan, I think it is targeting sort of 4,500 within, I think it was by the end of the year actually, which would be a let's just measure here. So from current price, this would be almost a 22% drop in the S&P. So if we do get that, we could potentially profit quite well. However, you would need to be positioned very well because again, if we just go back and look here, let's say you were doing a very similar thing, let's say from the 2nd of November 2022. So let's draw the date range here. So it would be till the drop, so around here. And then let's grab the price range here. So let's say you shorted here. So you would have had 434 days of drawdown, and that drawdown would have peaked at 37%. So that's what I mean. You need to be very careful because if you were trying to DCA this, unless you were going in very small positions with a large amount of capital, you would have been liquidated pretty quickly. So yeah, I'm definitely not endorsing this. And again, it's more than likely not something I'll do unless I see a catalyst or something very, very obvious. But again, it's something to keep in mind. It's something interesting. So there you go. So finally, the New Zealand dollar, it's exactly the same or almost exactly the same as the Australian dollar. So we can see on the daily time frame here, we've got this 200 moving average that is slowly coming up to potentially meet price around here. We've got this really nice level of daily support. So looking for a potential lower move here on the New Zealand dollar, so we can potentially get in to go long. So the reasoning here, the New Zealand dollar has gained on the back of stronger global risk appetite and expectations for fiscal stimulus from China. While the RBNZ may cut rates in the near future, the market has largely priced in this expectation. If the NZD could benefit from improved global sentiment and China's recovery, however, caution is advised that the NZD remains vulnerable to volatility. So this isn't the strongest trade idea on the list that I've shown you, but it's definitely got potential. So we wouldn't be targeting anywhere new, really. We'd be sort of looking more towards this previous high area. That's the wrong tool. Here. So yeah, around sort of the 0.635 level would be where we'd have our take profit. And from there, we may not look to target any higher, just to obviously reduce risk and get out of the position. But again, it is one of the weaker trade ideas that we've got on this list. So that's it for today. Again, like and subscribe as always. And if you want to join the Discord, follow Signals and get some education and things, then you can again click the link in the description, and I will see you next week.